impressive, right? We're just 1% off of all-time highs as of the close yesterday. It hardly feels like the jitters of 2 weeks ago even happened. I think the market's really going to be focused on the Fed, on what Powell says in Jackson Hole. If I were him, I'd be thinking about probably keeping my message pretty consistent with what I've been saying for the last couple of weeks. The minutes are coming out from the meetings in July. I think the big incremental data point that we might get that could change some of the messaging is going to be the BLS revisions to previous jobs numbers that's going to come out tomorrow. I think if that shows an increased weakening of jobs data in the last year, then that could put some of the discussion around, is the Fed behind the curve? Do we need a 50 basis point rate cut back on the table?
I wonder what you think about our expectations for the Fed. I showed a chart at the top of the show, and we'll try and pull it up again. It's 392 on the Bloomberg, which shows what the market is pricing in right now, and it's over time. So at the beginning of the chart, pricing in one rate cut for September and a couple more. Now we're pricing in a rate cut at each of the next 5 Fed meetings. If this is a soft landing, Emily, do we really need to cut rates 125 bips?
Yeah, I think that's a really good point, Matt. I mean, I think it's going to be really data dependent. I think what the Fed is going to be looking at now is really focusing on that second mandate. We've seen inflation data really start to come under control, an indication that prices are more stable and they are rising at a more reasonable pace, but now we need to shift focus to that second mandate, which is full employment. And so I think it's really going to depend on the data that we see coming out, through the course of the next 3 to 6 months.
Well, there's also the discussion to be had is when they start cutting rates, and if they keep cutting rates 5 times over the next 5 meetings, like Matt says it's priced in, are they easing policy truly, or are they just normalizing? From where you sit, at your perch as a portfolio manager, how much does that difference matter?
Well, we're fundamental investors and we're fundamental growth investors. And so, we really do look at, obviously, the macroeconomic impacts of, where the U.S. is. But we're also really focused on investing in businesses that are able to grow their earnings power throughout an economic cycle. So that's why we still really like the AI theme. We think we're at the very early stages of the build out of that tremendous platform shift. We really like healthcare names, particularly healthcare names that are exposed to some of these big mega trends that aren't going to change whether the economy in the U.S. is in a recession or not. And then the other thing that we like to remind our investors, because we're really internationally focused, is there are long-term winners and alpha generators outside of the U.S., and this might be a time to start thinking about diversification outside of the U.S.
Emily, would love to double down on some of the names you like, particularly in certain sectors. This is a massive week for consumer-focused stocks. We're seeing a ton of divergence. What do you like, and why do you like it?
A ton of divergence, particularly in the U.S. I mean, it's really interesting to see how, some of the value-focused names like Walmart and even, Amazon commented on this in their retail business and when they reported a couple of weeks ago. And then you've got, Home Depots and Lowe's and some of these bigger ticket items really starting to show that slowdown. So in our portfolio, we are really taking that sort of high-low approach. Again, we're international investors. We really like the ultra-luxury names where we think the consumer is going to be a lot more resilient. So your Brunelo Cucinellis, your Ferraris. And then on the lower end, we're really focused on value-for-money retailers. B&M Retailer is a UK value-for-money home goods retailer that we really like as well. So we're really taking that high-low approach. We see that trend across markets.
We've been talking a lot about, obviously, the GLP-1 drugs for over a year now, and I know you like Novo Nordisk. What about the competitors? We were talking today about Eli Lilly's Zepbound, looking good in a study, a 3-year study, to reduce your risk of diabetes by 94%.
Really, really good data from Lilly today. We continue to think, again, this is a massive long-term trend, and there are going to be more than one winner. We think that Novo Nordisk has a great first mover competitive advantage. Lilly isn't far behind. But if we take a step back and we think about it, there are over 1 billion people in the world today that suffer from obesity, and that number is only going to grow. And if we count up all the people that have taken a GLP-1 drug for obesity, we're only in the tens of millions. So there are a lot of winners that are going to come out of this transformational therapy to help obesity over time.
I want to just touch on the Alzheimer's plays that you like also, because you've got a couple of stocks here in your notes. And is this trade as crowded as the GLP-1 trade, or do you think it's, we haven't really turned the corner yet for these treatments?
Yeah, Alzheimer's is an area that we've been focusing a lot of our research. We do think we're at a potential tipping point of transformation in some of the Alzheimer's therapies that have been coming out. Some of the leaders in this, a Swedish company called Biogen, they have really helped to commercialize a new drug that's just come out on the market, in addition with a Japanese company, Eisai. And, so you've got a number of different companies that are sort of starting to come back to this market to spend R&D dollars. Again, this is a huge problem societally with an aging population. You've got over 50 million people that are suffering from Alzheimer's disease today. And, so we really think that we're starting to see some real transformational therapy come onto the market, and we think expectations are well calibrated. We don't think that this is a crowded trade the way GLP-1 is. And even if we look at GLP-1, again, when we think about the long runway for growth and the potential for new applications of GLP-1 drugs as well in things like kidney disease and heart disease and even for Alzheimer's disease, we think there's a long runway for that earnings power to keep growing.
It's a great point that there's plenty of opportunities beyond just the GLP-1 trade, which in the short term, as you say, is a little bit crowded. I actually want to go back to luxury. Of course, some of the names you mentioned, Ferrari, for example, you have that on one end, then you have Costco on the other end. So there's a lot of daylight in that barbell. What happens to aspirational luxury in this environment? Of course, we talk all the time about the trade down, that's how that's benefiting the likes of Walmart, Costco, for example. But for the luxury names that aren't quite on the Ferrari scale, what happens to them in this environment?
Yeah, that's where we're a little more concerned. That's why we've sort of steered clear of LVMH for now. We saw in their earnings release that they're really seeing a slowdown in the United States. We do think it's that aspirational consumer that that college grad that got their first signing bonus, that maybe went to buy a nice handbag to reward themselves. Maybe they're feeling a little bit less certain about doing that right now in this environment, considering also where prices have gone. A lot of these luxury brand companies were able to take a lot of price, and that really hurts their entry-level consumer a little bit more. So we really are taking a more cautious approach on the consumer and focusing on that ultra high end where the jobs data, the inflation data really just doesn't affect those consumers in the same way.
Emily, I'm also interested in how you define consumer and play around it a little here, because you're looking at MasterCard as a consumer play as well. What is it that you like about MasterCard, and how do you feel about that dovetail between the consumer and the financial sector?
Yeah, I mean, we really like MasterCard. We like MasterCard because we think it has a longer runway for growth outside of the United States as well. MasterCard is pretty heavily exposed to travel. We saw, the U.S. consumer taking advantage of that strong dollar this summer, taking advantage of, of sort of feeling really good out, post-COVID. There was tremendous amount of travel to Europe this year. MasterCard is a beneficiary of that cross-border travel, also a beneficiary of cross-border e-commerce, something that we started to see, really take off around COVID. Took a little bit of a back seat as consumers started to go back and start shopping in brick and mortar stores, but we think that that trend is going to continue, and we think that the competitive moats around MasterCard, Visa, these multifaceted networks, they're really, really, really hard to compete with, and they've really been instrumental players in sort of helping build out the fintech ecosystem around them that people used to sort of talk about being a competitive threat.